Hello and welcome. My name is Evan Branken and this is Adulting 101. And we're joined by former insurance salesman Aaron Gennari, who's going to be walking us through the major types of insurance. Aaron, take it away.
Hello, again, my name is Aaron Gennari, and today I'm here to talk to you about insurance. I was an insurance agent for 12 years, with Nationwide Insurance in Des Moines for 2 years, and then Farm Bureau Insurance here in the Quad Cities for 10. I think the three main insurances people deal with are health insurance, property casualty insurance, and then also life insurance. So let's talk about health insurance first, because certainly this is the one the law requires us to have, as we know, and it's been in the news a lot. So you can have group insurance through your work, or if you're under 26, still potentially your parents' work. You can also have individual insurance if you're not covered through a group policy, or maybe the group policy isn't that affordable or doesn't have very good coverage. Within the last 10 years, you can also potentially qualify for what we call the exchange, which is insurance that's subsidized by the government based on your earned income for the last year. So let's talk about group versus individual versus the exchange first. Generally, most people in the United States are covered under a group policy, under your own employer, under a family member's or spouse's or parent's employer. Generally, group insurance is going to be the most affordable option. Not always, and oftentimes provides the best coverage and the best network for you. We also have individual insurance. So if you're like me, I'm self-employed, so I actually have to go out and find my own insurance policies. Now there's a government exchange that can help subsidize an individual policy and help lower the premiums, or it can help lower the out-of-pockets or lower the deductibles. So let's talk, what parts of health insurance do we need to look at? What's important? The first part people think about is the deductible amount. It's going to be the amount that you have to pay. If, say, you go to the hospital or you have a surgery, you have to meet that deductible amount before your policy kicks in. It's generally for your major medical procedures like surgeries, birth of a child, things like that. So what's a copay? When I go to my family doctor, my copay is $40 every time I go see him. My specialist copay is $90. And those don't go towards my deductible. Those are a separate category. So you certainly want to know how much is my monthly payment, but also how much do I have to pay when I go to the doctor each time, because those are all going to factor in. And so now I've met my deductible for the year. The good thing is it's not a per procedure deductible. It's actually a per year deductible. So now if I have another procedure 6 months down the road, as long as I'm still in that same calendar year, I've already met my deductible. So coinsurance, say we have an 80-20 policy. What's that mean? Well, that means once you hit your deductible, your insurance policy is going to cover 80% of every bill, and you're going to pay 20% of each bill until you reach your annual max out of pocket for the whole policy. At which point, now everything that's covered under the policy, you don't have to pay. You need to look at the network of doctors and the network of hospitals. If you already have a family doctor, ideally you're looking for a policy that your family doctor is in that network. Or if your family doctor isn't, is there a family doctor you can find that is? Finding a company that's got a broad network where you live is a very important part of the policy too. But what the heck is a network, you might ask? Basically, when an insurance company comes into a market, they're going to the different hospitals and the different doctors, and they're partnering with them. And what that means to me as Dr. Aaron is I'm going to accept their negotiated rates. So I'm probably going to take less than my standard fee. What I get back is I get access to all the Blue Cross Blue Shield patients in my area. Do I have to go to a doctor in my network? If you stay in network, what it means to you is you're going to pay considerably less. If you go out of network, what it means to you is you're going to pay considerably more. Some policies, you have to stay in network to get any coverage at all, unless it's an emergency. If you have a group policy, oftentimes if you have questions, you may talk to your group HR person. Maybe there is an insurance agent that comes in for the group to ask questions, or maybe you have an 800 number. If you're buying an individual policy or potentially through the exchange, you're going to want to find an insurance agent, because now you have that person to help you quarterback you through that journey. Ask your family, ask your friends, and see who they know, interview them, find a couple people, and then settle on that one you know, like, and trust. Again, as we just talked about with health insurance, maybe the most important part of home and auto insurance, and then eventually life insurance, is finding that advisor. Well, you don't know if you have a good insurance agent. You don't know if you have a good insurance company, or you don't know if you have a good policy until it's time to file a claim. Do that homework on the front side, so when we do have a big hailstorm and you need a new roof, you already know you have a good insurance agent. You already trust them to know you have a good policy. They've helped you walk through that, so you have a much better claims process. You know that you have a reputable insurance company that pays their claims, that's financially valuable. Here's what I know about customer service and knowledge based on the internet. They're not asking you any of these questions about what your needs are. So I want you to talk to somebody that's a trained expert. Let's talk car first. If you own a car, if you have a loan on that car, you have to have full coverage. What does that mean? That means that you have to cover the bank's interest in your car. So if you get into a car accident, and it's your fault, your insurance policy will pay to fix your car or pay to replace your car. The lower the deductible, the lower you have to pay to fix it, but the more you're going to pay on a monthly basis. The higher your deductible, the more you're going to pay to fix it, but the less you're going to pay on a monthly basis. Well, here's my question to you. Even though you don't have a loan, nobody's requiring you to have full coverage. If somebody stole that tomorrow, do you have $10,000 or $12,000 to go out and replace it? If the answer is no, then I highly suggest you still have full coverage, and there's two different parts to an auto policy. Comprehensive covers anything to your car that wasn't caused by collision, theft, hitting a deer, a hailstorm, a tree falls on your car, vandalism. Comprehensive is usually the cheaper of the two coverages, so sometimes you opt to have a lower coverage there. So that collision deductible or that collision coverage is what happens if you get into an accident and it was your fault. You pay that $500 or that $1,000 deductible or whatever you decide on, and then your insurance company is going to pay to fix the rest of your car. These are both covering the damage to your car. The other part that collision coverage can cover is if the driver hits you and maybe it's a hit and run and they don't catch him, or maybe an uninsured driver hits your car so they don't have insurance. One would be rental car reimbursement. Basically what that is, you get into that collision, your car's in the shop for a week or two. It's going to cover your costs for the rental car, towing and labor coverage. Sometimes it's called roadside assistance. It's going to cover if you lock your keys in the car, you get a flat tire, you run out of gas, you need a jump because your battery died, or just need towed. Crash and total the car, you owe $38,000, the car's only worth $32,000, and you have a $6,000 gap. If you didn't have gap coverage or some sort of coverage through the loan, liability. The most important part of auto insurance, the part that's required by state law. Even though you did everything right, you could still be held liable. It's also going to cover if you do get into that car accident and it is your fault and you damage the other person's car or you injure somebody in the other car. In the state of Iowa, the liability coverage minimums are $20,000 bodily injury per person, $40,000 per accident, and $15,000 in property damage. So that first number, bodily injury per person, means if I get into an accident, it's deemed my fault or that I'm liable. Whatever this number is, this is the most amount we're going to pay. It doesn't take very long to rack up a $20,000 bill. So $20,000 per person is woefully inadequate. The whole goal of insurance is to protect your assets. So if you get into an accident, you're not left trying to pay for somebody for the next 20 years by them garnishing your wages, or you're trying to file bankruptcy to get out of it. And then what do these things cost? I think you'll find to increase your liability limits isn't as expensive as we think. Bodily injury per accident is the exact same thing, except if we have $100,000 per person, well, if there's 10 people in the car, how much are we going to cap out at? Again, generally what we were recommending when I sold insurance is $300,000 per person as a bare minimum. And then the last one, it's property damage. Again, the state of Iowa requires a minimum of $15,000. I should say each state's got different requirements. So if you're not in Iowa, you need to find out what the requirements are. It doesn't take much to do $15,000 in damage. We used to write up to $100,000 in property damage. We already talked about how a lot of times people don't carry insurance even though the state requires it. So what happens if they hit you in your car and they injure you? If you have uninsured or underinsured motorists, if they don't have enough coverage, then your policy is going to kick back in and cover you and your passengers in your car. Why would you cover others for more than you want to cover yourself or your passengers? So now let's go into home insurance. So when we talk about home insurance, there's actually a couple different kinds. Homeowners insurance, if you own or are buying your home, but there's also renter's insurance if you don't own it, but you're renting. There's two main coverages. The first one, we're going to cover your physical property. In the home, it's going to be the home itself, any detached buildings or garages, sheds, fences, things like that. And then also your personal property or your contents. What do we mean personal property? I want you to take the roof off your home. Now I want you to take the building and tip it upside down and shake it and keep shaking it until everything falls out. And whatever just fell out, that's what we're talking about for personal property. If it didn't fall out, your toilets, your cabinets, things like that, we don't have to worry about it. Let's put a value to all your stuff. And this is a great opportunity first to talk about replacement costs versus actual cash value. Auto insurance policies are written on an actual cash value, so they bring depreciation into the game. With property insurance, we tend to write it on a replacement cost basis. I want to make sure that if we have a fire, that I can send you back out and you can buy a brand new couch. I want you to kind of walk through your apartment or your house with me. Just open it up and how many shirts do you have? How many pairs of pants or how many dresses do we have? It doesn't take long to get several $1,000s in value if we had to go and buy each one of those brand new again. The other thing I like to do is let's just walk into the kitchen. Let's just say we have 40 spices in there, and each one of them is worth $3 a spice. We've just did $120, and we're in the smallest cabinet in your kitchen. We haven't talked about replacing bedroom furniture. We haven't talked about TVs. I think you'll be surprised. The monthly premium or the yearly premium doesn't really make that big a difference versus if you have that total loss. I promise you, people have come back and said, Aaron, I wish I would have listened to you. I needed more coverage. Nobody's ever said, Aaron, this is too much money. So there's a couple different ways we're going to come up with values for how much we're insuring the house. Generally, the rule of thumb is the house needs to be insured to 100% of replacement cost. That means how much is it going to cost to rebuild your house like it is today, but brand new. Or you need to insure it for the loan value. Generally, the better practice is to that replacement cost. In addition to that, they're going to have other coverages on there, like X percentage of the house. We used to write 70% for your content. So they'll replace up to $140,000 in all your personal property. All those things as we shake the house upside down, everything that fell out. Now, if you decide, hey, I have some really expensive stuff and that's not enough, oftentimes they can increase that amount. And then they're going to have coverage if you have detached garages or fences or pools. You need to talk to your agent and understand what are my coverages for these individual items. There is a deductible, and that's the amount of the loss that you're going to pay first. What I don't want you to do is look at it and say, hey, rather have a low deductible, and to get my premium down to where I want, let's just lower the coverage. Insurance is a catastrophic policy. It's designed to protect you from a catastrophic loss. If you have a $200,000 loss and you only have $150,000 in coverage, that $50,000 gap could be very catastrophic to your long-term future. You now have less house, or you have more debt. Make sure you're not sacrificing coverage to get price to come down. There are some extra coverages. Maybe you have a finished basement and you have a sump pump or a sewer down there. You want to probably talk to your agent about backup of sewer, drain, and sump pump coverage. If you have things like expensive jewelry or expensive electronics, or talk to the agent, say what's the best way to cover these. Let me back up 1 minute. We didn't talk about liability on the house. Maybe the most important thing that people forget. And I'm going to use the example of an angry dog. Let's say we let the dog out and a neighborhood kid comes to play with it and he scares the dog. And even though your German Shepherd's never been a violent dog, now it bites that kid in the face or it bites that kid in the arm and does some really severe damage. Who pays for that? The liability policy pays for that. Liability on a homeowner's insurance policy is the cheapest coverage on there. So now let's talk about life insurance. We're insuring your life. If this policy is enforced, when I die, whoever I give it to will get X amount of dollars at my passing, whether it be $50,000 or $100,000 or whatever you choose your death benefit to be. Every day we live, we're one day closer to death. Every day we live, it gets a little more expensive to buy life insurance. So it's never going to be cheaper than it is today. Generally, we don't get healthier as we age. Maybe you're still insurable, somebody will still write a life insurance policy on you, but it's now more expensive. There's another possibility. Let's say you develop cancer. Suddenly that makes you realize, hey, I probably need life insurance. Well, nobody has to write that policy on you. They may say, hey, you're no longer a good candidate for our policy, and you may not be able to buy life insurance going forward. In general, we talk about permanent life insurance, or we talk about term life insurance. Term insurance, say we take out a 20-year term policy for $100,000. What does that mean? That means that I have a death benefit if I die in that 20 years of $100,000. At 20 years and 1 day, I have to go out and try to find another policy, and it's probably going to be extraordinarily more expensive. With permanent insurance, depending on the type of policy, maybe it's going to run until you're age 121 or basically until you die. And you have to pay X amount of premiums for X amount of time, and it's probably going to develop some sort of equity or cash that you can pull out of this if you decide, hey, I don't need it, or hey, I really need this cash equity, and generally it may increase based on the returns of that policy, so that equity could start earning dividends. The question is going to be, what do I need, Aaron, and how much do I need? It's not a static number. It changes over time. Right now, maybe you don't have a tremendous amount of life insurance needs, probably trying to pay off your debts so you're not leaving anything behind to your family. Let's say you get married. So suddenly you need to make sure that you're each insured. You're not trying to get the other spouse rich. You're trying to help maintain that financial promise you made together when you also made that faith commitment to be married till death do us part. As you have children, your needs increase. It goes the other way too. As you get older and as you get closer to retirement, your need to replace your spouse's income or your income certainly drastically reduces, and it's just really important to sit down with an advisor, talk to them about them. There'll be some worksheets they can usually help you fill out, and you'll come up with the need. Let's talk term insurance is a very affordable option, considerably cheaper than permanent insurance. If I have a convertible policy, we can convert that into a permanent product so it guarantees my insurability in the future. So nobody generally plans on dying while they're still working or dying while they're at the job, If it's not a portable policy, or if you can't take it with you when you leave, it can't be your only solution. Generally, if you're married, you're probably going to leave it to your spouse, or you may leave it to your children, or you may leave it, to a nonprofit, to your church. There's a lot of different options there. Generally, with that, you want to talk to your insurance agent, and then maybe an attorney to help set up a trust or establish what you want or how you want that life insurance to be paid out. Let's talk about the one most important thing. I don't care which insurance we're talking about. And it's review, review, review. You vetted the advisor you know, like, and trust. Ask them to sit down with you once a year and just review the policies. With that, my friends, that's Insurance 101.
Thanks for watching. This has been another video in our Adulting 101 series. If you enjoyed it, please hit like, subscribe, click the bell so you're notified when we release new content. We'll be doing more videos in this series on a variety of topics, but if there's something you really want to hear about, feel free to let us know and we'll try and make a video just for you. Thanks, God bless, and have a great one.